This is Danny Gould with the Selling Silicon Valley Group. Welcome everyone to another Silicon Valley market snapshot for the third week here in February of 2020. Let's start today off, everyone, by going over an article that I just read on this SF Curbed or Curbed SF. It's the first time I've seen an article from them, but thought it was interesting. San Jose called hardest place to buy in the United States. To buy a home, that is. San Jose called the hardest place in the U.S. to buy a home. Inventory in Silicon Valley capital is up, but it hasn't made a dent in the problem. Oh, I see what they're saying. The Silicon Valley, the capital of Silicon Valley is San Jose. So, there's a couple of points here in the article that I thought were worth mentioning. San Jose had a median home price of $1.1 million last year and only 4 active listings per 1,000 household. Not very many active listings. And, they go on to talk about how this compares to other cities in San Francisco and Oakland and Fremont and Santa Rosa. And what they've concluded is that this is the tightest inventory market in the Bay Area. And that San Jose rather is the tightest inventory market in the Bay Area. Trulia, 1 year ago, I guess, singled out San Jose as the #1 metro area for inventory growth, and apparently it doesn't translate into measurable relief on housing demand. Everything the city and the region have done in terms of new housing is just getting swallowed up by a market with an insatiable appetite. This is a really good segue for today's Silicon Valley snapshot, everyone. Because right now, what we're experiencing are some lagging, or we're looking at lagging measures, but can quantify what the next 2 to 3 months are going to be just based off of the overall environment and what we're experiencing in real time here on the front lines in Silicon Valley in the real estate market here. So, look, there's a couple things here that are worth pointing out. I have written on my whiteboard here that the inventory levels across Santa Clara County and San Mateo County in both the single-family sector and the condo and townhome sector has dropped significantly year over year. This is not front page news, but even last year, right, the inventory levels weren't exceptionally high. When you look at a typical market, actually, when the market was considered neutral in Silicon Valley, it was almost 2x as much inventory as we had on the market last year. What happened, right, and if you've been watching these videos for any period of time, you'll know that in 2018 at the beginning, there was so little inventory that there was an artificial spike in housing prices, and these prices were unsustainable. And so as we went into 2019 with this excess of inventory, when you compare it especially now year over year, quite excessive amount of inventory, then those prices just didn't match up because the consistency of the demand here in Silicon Valley is undeniable. The number of homes that are sold year over year does not fluctuate very much, and if you've been watching these videos, you'll know that that's the case. However, what does change and what predicates the market conditions are the inventory levels. And so what this article astutely pointed out is that San Jose is supposedly the hardest place in the United States to buy a home. The reason it's the hardest place to buy a home isn't because of tech giants hiring people in droves. That certainly feeds into everything, don't get me wrong, but the demand has been there for quite some time. And so, and obviously demand is heavily influenced by that. But what my point is that the actual appreciation of home prices here in Silicon Valley is predicated upon the low inventory levels that we've encountered year over year over year over year. And so the question becomes, what is going to lead to a surge in inventory, another surge in inventory that's going to cause the market to go down? I've heard from many experts, a lot of people that supposedly feel that the market is going to go down. And my question is, where is this artificial housing supply going to come from? Because it's certainly not going to come from the people that are currently living in their homes. Almost all of them can afford to live there. I mean, all of them can essentially afford their mortgage. What's the interesting part is that the majority of the people that are moving out of the area are moving out for two big reasons. Number one, there's a job opportunity in another metro, okay? And that job opportunity in the other metro is going to pay roughly what it pays here. However, that metro is significantly less expensive to live in and significantly more affordable. Totally fine. That is a totally understandable reason to leave. The other is the Silicon Valley homeowner that has lived in their home for 20 to 30 years and now has a significant amount of equity built up into their home. And that equity is their piggy bank. Okay? And so what we're seeing is that a lot of these baby boomers are leaving the Bay Area, but they're leaving only if and only if it's their only option, or if the family, the kids, and everything are already moved out of the area, right? If there are still roots keeping them here in the Bay Area, they're going to do everything that they possibly can to stay in the area. And that includes taking out some sort of home equity line of credit. That also involves perhaps borrowing against their house in some other way, shape, or form. Or some people even do reverse mortgages. There's a plethora of different strategies to use that home equity as a piggy bank. And so, when I'm going off subject here a little bit from the typical Silicon Valley snapshot, because this is something that's been weighing on my mind recently. But when you look at the amount of debt on these properties, it starts to get a little startling, right? Because these are people that had a lot of equity, and maybe now things are getting a little tighter. We can expect the piggy bank to run dry at some point, right? And so, if there's another correction in the market that brings the prices down to a level where some of these sellers are now close to being underwater, where some of these homeowners are close to being underwater, this may cause another surge in inventory. Of course, I don't have the statistics, I don't have the analytics in front of me. This is all just based off of gut feel. However, how long is that going to take to come to fruition? Because I'm telling you, it ain't going to come to fruition in the next 18 to 24 months. That's for sure. And what we really want to start thinking about as Silicon Valley home sellers and buyers is, what does the immediate market look like for me, and what does the market look like in 5, 10, 15 years? Don't get me wrong. Most of my buyers, when we sit down and we go over the home buying process, I instill this idea, this notion that we should really be making offers on homes that we really love, because this is a home that you're going to be living in for 5 to 10 years, maybe even more. And so why buy something just for the sake of buying it if you're not actually going to enjoy living there? And so we want to separate investment decisions from housing primary residential decisions. Wow, I messed that one up. So we want to separate investment decisions from personal residence or primary residence decisions, because they're not always going to be one and the same, right? But here's the punchline. San Jose is the hardest place in the United States to buy a home. When is that going to change? I'm going to guess not in a long time. As long as the internet's still good, as long as Google's still running, as long as Facebook is still running, which, by the way, if I have a couple people to bet on, I'm going to bet on Mark Zuckerberg and I'm going to bet on Elon Musk. They both have their corporate headquarters here in Silicon Valley. That's just the way it is, guys. And so when we think about the market in the next 5 to 10 years, when we just look at that, there is no better place to bet on appreciation potential over the next 5 to 10 years. For those of you that are sitting on the sidelines and waiting for the market to crash again, good luck. Good luck. You're going to be waiting a really, really long time. You could wait for that next wave of appreciation to occur, and then some sort of extraneous factor like the one I just mentioned, right, with the increased debt in the ecosystem causing some sort of surge in inventory in the distant future. But how much is the market going to appreciate between now and then, and how much money are you really going to be saving? It's a fair question to ask, right? And if these aren't the questions that you're constantly thinking about, then you're going to miss the mark. You're going to miss the mark. And so where are we now? Where are we now, and where can we expect to be heading into the spring of 2020? Well, I'll tell you one thing. Over the last 2 to 3 weeks, we as real estate agents here have experienced massive amounts of foot traffic in the Bay Area at our open houses. The demand is still there. The inventory has shrunk, and that's going to cause pressure on prices. If you've been watching these videos for any period of time, you'll know that this is not front page news. This is something that we've been talking about for a very long time, but now more than ever, I feel very bullish on the next 3 to 6 months here in Silicon Valley. Can't predict any further out than that, especially with elections and everything coming up. People get weird around election times, and honestly, it's hilarious. But if you're a home seller and you're thinking about doing it, now is the time. Do not wait until April or May, where the inventory goes up and you have more competition. Go on sooner rather than later so that you avoid the mad rush of inventory come May, June, July, and you get your home on the market and exposed to a plethora of buyers without the competition. Now, if you're a buyer in this market right now, buy a home that you really love. Do not get swept up into the herd mentality that these kinds of markets create, because this kind of market creates a mentality where I have to buy now. 5, 10 offers, 15 offers on a property, 20 offers on a property, and you just want to put an offer in to make the offer, right? Because you just want a house. Well, I get that, and by all means, I'm all for you buying the house, but only make the offers on the homes that you love, and then when you find that house, write it to win. Because if you do not write it to win, this is what's going to happen. The next home that comes on the market is going to be priced at or above what the home that you bid on sold for. And so you're going to end up paying more and more and more and more in this market. Sure, there will be a cooling off period, but the cooling off does not mean depreciation. Does that make sense? That means less competition and homes selling for around list price at market value, not 5-10% below market value. Now, there might be a period in time where that happens, but that's not going to happen in the next 3 to 6 months. So if you're a home buyer that's buying in 2020, take that advice and take it to heart. And if you're looking for someone that has a stellar track record getting their buyers' offers accepted, our clients actually, in the mad rush of 2018, had over a 75% success rate at getting their very first offer accepted. Something to think about, right? And so my team is trained on getting you the house, which is exceptionally difficult in this market. The negotiations are much different in an environment like this than they are when there's just one offer on a property and you're negotiating one-on-one. There is skill, there is technique, and there is strategy involved in getting your offer accepted when there's 10 other offers on the table as well. So, food for thought. And obviously, if you're a home seller, and there are so many nuances to the market. These numbers are not necessarily relevant to you, and so it's. I was just sitting down with a gentleman in Saratoga just last week, and we were talking about his properties, a $5 million home in the hills, and we chatted for a good long while. Because some of the activity that we're seeing here does not necessarily reflect on what's going on in your neck of the woods. So let's sit down, let's go over your situation in particular, and really make sure that we're making the decision that's best for you and for your family. Right here, Silicon Valley Snapshot, generalities. Let's get together and talk about your specific situation. Guys, so many good pieces of information here going into the next 30 to 60 days. If you're a seller, just one last, do not sit on the sidelines. If you are thinking about selling your home in May or June, do not do that. Do not do that. Do not do that. And if you want to understand why, and you really want to have that conversation, call me and we can have that conversation as to why. Because May, June, July, worst times to sell your home. Specifically June, July, not a good time to sell. And if you're interested in why that is the case, call me. This is Danny Gould with the Selling Silicon Valley Group. Thanks for watching another Silicon Valley Snapshot, everyone, and we will see all of you in the next video.